I'm speaking with Dr. Christian Baylis, Chief Investment Officer, Fortlake Asset Management. First up, Christian, thank you very much for participating in the Inside Network's Income and Defensive Assets Symposium.
Thanks, James. No, very much appreciate you having me. Thanks.
Christian, how do you feel fixed income is being redefined in today's current and volatile market environment?
I think it's an interesting topic because I think really what's changed since 2007, 2008 is the market's become bifurcated, particularly in the credit markets, which is obviously a key source of income for a lot of people, and people rely on the credit markets to be open. And what I mean by that is capital regulations and these sorts of things have basically stymied what I would call warehousing of bond holdings on bank balance sheets. That means you get less liquidity in public markets, in my view, in the cash bond space. And what that ultimately leads to is it means that the public markets are becoming more like private markets. And I think what you see also on the private area is not an area of my focus, but I think private markets are becoming a little bit more public in terms of the liquidity terms that they're offering. So it's almost like the two areas are converging. And I think there's opportunities on both sides of that for investors.
What particular opportunities are you seeing in areas like default arbitrage and credit derivatives?
Yeah, well, certainly on the recovery rate side of things is I think it often surprises people when I tell them that the locked-in recovery rate in the US I'll talk about is 30 cents in the dollar. So whenever you get a high yield default in America, it is locked in that you would expect a 30-cent recovery rate. What we're actually seeing post-pandemic is it's more about 9 cents on average. And what we're starting to see is defaults picking up across public and private. Bankruptcies are on trend to be almost at their highest level through the bankruptcy courts in the US in terms of the data that we pull out there. And what we see structurally speaking is that the increase in technology issuers and the increase in corporates that issue debt that have very little in the way of tangible assets on their balance sheet is giving rise to pretty poor creditor outcomes. And so you've got to think about a strategy which can be devised to take advantage of that, and that's certainly something that we're spending a bit of time on.
How do you balance income generation with active risk management in your portfolios?
Well, you've got to do it sequentially. Always manage risk as the first priority, and then think about the alpha generation, which in my view, income falls into the alpha generation. It's just one source of the return. Obviously, capital's the other side of that. So sequentially speaking, in our view, you're always better off having explicit volatility targets or downside volatility targets. We try to live and die by those, and we call that the loose rope that we need in order to generate the upside return that we generate. We try to be very clear with our investors so we attract the right type of capital, making sure that they understand what a bad day in the office looks like and also what a good day in the office looks like. But really what you're finding is that tax is also a big issue for a lot of people as well. Some people, depending on the products, want lots of income, some want more capital, and really what we've tried to do is devise a range of different strategies that cater to both audiences.
You mentioned some of the pieces of data that you follow.
Yeah.
What trends within default cycles are you monitoring most closely at the moment?
As I said, recovery rates is a big factor. Then also the pickup in public and private public and private bankruptcies that we're seeing, particularly out of the US. Also, what we're seeing in Europe is basically it is coming home to roost. In the infrastructure issuer area, a lot of the infrastructure issuers dress themselves up as infrastructure issuers, but they were ultimately probably technology companies. They went into Europe to take advantage of the various different solvency regimes, circa 27 different solvency regimes. They took advantage of low interest rates, i.e. very low term structure when interest rates were negative in Europe. And what you're finding is some of those issuers have not been able to stagger to their feet, and we are starting to see some divergence between the really bad names in the triple C area and then also the double B names, which are actually in pretty good health. So that's certainly something that we're watching.
How should advisors think about using fixed income as a dynamic tool rather than the passive ballast view of the asset class?
Yeah, well, this is something that I've talked about quite a lot, is that really when you think about it, is given the liquidity and the structural changes that have happened in the credit markets, what that means is that the credit markets aren't always open. Unlike the equity markets are always open, i.e. if you need to sell some BHP stock or buy some BH stock, you can do it in Australia any time of the day. You can even go across to London and the US and do it. In the credit markets, you can't do the same thing with an equivalent bond, and that is a big problem. And so what you actually have to do is you have to devise a strategy which is passive in terms of what you do on the bond side, but you also have to have 24/7 options that you can use any day of the week in order to manage risk and also to manage alpha as well. So you need to have a foot in both camps, in my view, meaning that what we're starting to see is that parts of the credit markets are becoming a little bit more exchange-like, but there's a sacrifice or there's a displacement effect in the cash bond market, and that means liquidity is being sucked out of that. So you really need to try and think about strategies in both areas.
Christian Baylis, Fortlake Asset Management, thank you very much for your time.
Thanks, James.